Types of segregated funds can be found in the Segregated Fund module section 2.2. There are a lot of different details, really dives into the types of funds in your study notes. So if you're looking for more information, please check out your study notes, the Segregated Fund module. Now, there is a lot of risk when investing in the market. It's important to keep that in mind. Really making a good recommendation for your client is based on their risk tolerance and also your thorough understanding about the type of funds that you are recommending to them. A lot of the funds you'll see are based on an underlying security, and that security can vary. It could be a lot of different things, and the risk is usually affiliated with that security that the fund follows. We're going to start off with the mortgage fund. The mortgage fund is, of course, secured by a mortgage. Now, there's a lot of guarantees associated with that. It's guaranteed with that mortgage. And the mortgage can be from 3 different industries: residential, commercial, or industrial. Now, the industrial mortgages are a lot higher risk than residential or commercial. And the risk affiliated with mortgage funds is default risk. And default risk is when a person who holds the mortgage cannot keep up with those payments, and so they aren't able to afford their mortgage or continue their payments as they go into default. It's important to know that with the mortgage fund, you do not own the property. It's just a mortgage. On the other hand, with real estate funds, you are actually purchasing, or the fund is actually purchasing real estate. So 90% of the funds are used to purchase real property, and this is affiliated, or this means that there is ownership of property within these funds. And the income that comes from real estate funds, either rent or capital gains. And capital gains come, of course, when the property is sold. Hopefully, or ideally, when you invest in these types of funds, the property value has increased over time, and therefore you do get some capital gains when it's sold. Now, real estate is an illiquid investment, so it is meant for clients who are looking for a longer-term investment. The property must be sold in order to get the money out, and so it's really important to understand that there is some liquidity risk with this investment. Next, we're going to go through the segregated fund, the index fund. And the index fund mirrors the underlying security. So whether it's the S&P or the TSX, Dow Jones, what's important to remember is this is a passive investment. And so the growth 100% depends on whatever that underlying security that the index fund is following. So this is really for investors who are looking to follow an index. They are looking for passive growth, so not a lot of activity. There's a lot of transparency as well, because they can see this index and what's happening on a daily basis. So that it can follow varying types of indexes: equities, bonds, commodities, currencies. And the risk that's affiliated, like I mentioned earlier, is really the risk is affiliated with that underlying investment. If the underlying index does badly, then so does this fund. And so that's the risk that's affiliated with index funds. The fund of funds, which is actually becoming more and more popular today, is the fund that invests in other funds or a collection of funds. And the huge benefit that investors are getting is they actually get that management expertise of the other funds that are being held. So they invest in several funds, they're collected into this one fund, and they're benefiting from all of these great managers who are individually managing these other funds. There's a lot of diversity affiliated with fund of funds, because you can find pretty much anything in any collection. And it really allows you to customize the investment for your client and what their wants and needs are. Again, the risk affiliated with fund of funds is that underlying investment, and those whatever risks are affiliated with those other funds that are being invested in. Specialty funds are a specific type of investment. So this is really a customized specific need that goes to exactly what the investor is looking for or feels that they want. So there's a narrow focus with specialty funds. They're really not for the mass market. They're specifically for certain types of people or people who are looking for something very, very specific. Now, some examples of that could be ethical funds. So people are really looking for perhaps funds that are not investing in the gun trade or tobacco or alcohol. There could also be reasons such as religious, political, moral. So there are varying reasons for why specialty funds exist. And typically people who are investing in specialty funds are not as concerned with the risk as people who are not. They're willing to sort of give up some of that security in order to invest in a fund that they feel comfortable with, whether it be morally, religiously, politically, or ethically. Money market is a very, very low risk fund. It is probably one of the easiest to understand. It's very simple to explain to your clients. 95% of the investment or 95% of the money is actually invested in short-term money. So whether that's cash, treasury bills, anything that can be easily liquidated. So that means that it can be sold very quickly. Now, along with this very low risk that is affiliated with money market funds, there's also a very low return. So anyone who's sort of just kind of looking to get their feet wet, feel very uncomfortable in the market, this is probably a good place to start. Bonds are a fixed income security fund. And what this is, if you've listened to the bond presentation, it's really about lending money. So the investor is lending money to a company or corporation. That company or corporation promises to pay that money back. That's essentially what a bond is. And bonds invest in other bonds. They can invest in T-bills. And the great thing about this is there is a regular income that comes from investing in a bond. So it pays a set amount of money on a regular schedule, whether that's quarterly, monthly, annually. And so the investor receives some steady income. And then their principal is available at maturity. Now, this is a short to medium term investment, so around 3 to 5 years. Long-term FY is 10 years and more. And this is also another low risk, low return type of investment. So when you're investing, when your clients are looking for something that is low risk, this is kind of where you want to put them. Equity is actually the opposite. So this is a much higher risk type of fund. Investors are looking for growth. They are willing to take on the risk in order for that growth to happen. So an example of this would be a small or a large cap growth industry. And the risk associated with this is actually industry risk. So if a company fails, then of course the fund that's investing in that company is not going to do well, and there is potentially a lot of money to be lost, which is why this is more of a high risk investment. Balance funds, which are also very popular, is a mix of equity and bonds, or stocks and bonds. Now, there are varying types of percentages between the equity and the bonds, or the equity and the fixed security investment. It could be 50-50, so 50% in growth, 50% in income, or it could be a 40-60. Like I said, anything sort of around that 50% could be a balanced fund, and there's so much diversity in this. You can really specify and set up something that your client is looking for. There is a lot less risk affiliated with balanced funds as well. Income funds are really popular for the older population because they have a steady flow of income. So there's a regular interest income that is coming to the investor, and so they're continuing to receive that money, whether it be monthly, quarterly, annually. There is some small capital growth, but these investors really aren't looking for growth, and so they aren't too concerned about how big the capital growth is. The income funds are primarily based on bonds, or there could also be some high quality stocks. So, for example, banks or insurance companies, government or corporation bonds, really things that are very steady and secure, will provide a regular income. Again, income funds, because of that sort of small capital growth, there is a low risk. The last fund that we're going to go through is a dividend fund. And a dividend fund invests in companies with a history of dividends. So typically those tend to be banks, insurance companies, and blue chip stocks. Oh, and also preferred shares. So remember, a preferred share, the dividend is distributed to a preferred shareholder before the common shareholder. And so there is some security affiliated with that. Dividend funds tend to be a low to medium risk depending on the underlying security. So again, as always, that risk is really based on whatever the underlying security is. Now, those are all the different types of funds that you can invest in your segregated fund module. If you have any more questions or you're looking for more detail, again, please refer to section 2.2 of your book.